say investor awareness or capital market, at times people want to know a lot about share trading and things like that. There's a different type of a subject, and he's going to do it in a lot of detail. Maybe before we start, so a few things on WIRC. A lot of different type of things which we are trying to do. And as we speak today also, we are having 2 days train the trainer. This is the 8th batch which we are doing. And in these 2 days, we got about 60 plus people attending on the 8th floor in the boardroom. And these 2 days, the training is all about like the making of presentations. How do you present? What do you talk? How do you make it more spicy so that people are interested by running quizzes, whatever it is. So like completely, it is like on personality building, on PowerPoints, on English, on presenting and all of those. Because whenever a person decides to stand up and talk on a particular subject, I'm sure technical knowledge he will have. The softer aspects we are working on. And we did, this is a 6th physical batch. 2 batches we did virtually. Total 8 batches have happened across the length and breadth of the WIRC. And today we are hosting it in WIRC in this building on the 8th floor. Similarly, one more program for 2 days that is on the real estate. And again, 2 days we are covering everything. So like there are lawyers also, advocates also who are going to come and speak on the title deed, whether it is a development agreement, whether it is a direct outright purchase, then the conveyance and things like that. But the aspect of GST is also getting covered. Detail RERA is getting covered and a lot of other stuff. And there also we had Arun Gupta coming from the Builders Association of India in the morning. And he himself being a builder or a promoter, he gave his point of view, like where does he look at, or how does a businessman, a promoter, builder look at, and what are the problems and the difficulties which they face. Different type of programs. We are also trying to do a lot of longer duration courses this year, whether it is on forensic, on cooperative, on RERA, on internal audit and risk management, so that different avenues can be presented to the members and members can pick up whatever they want to do and pick it up as an area of practice along with the normal practice. So that is one. But in addition to that, we are also doing a lot of technology-based programs, and be it like usage of Tally or features in Tally, or be it R, Excel, Tableau. We are also running 2 longer duration technology courses. Part 1, we are covering the coding in Python language and SQL database. 60 hours, 9,000 rupees, Saturday, Sunday, you can sit at home and do it. And you can bring practical data from your office for doing reconciliation of 2A, 3B, reconciliation of professional fees and TDS on professional fees and things like that. And you can use it in your office. And of course, a lot of it can also be used in your statutory order, tax order for selecting samples and doing the other work. Part 2, we are teaching Power BI, Power Query and Tableau. So a lot of presentations, the bars, graphs, diagrams, charts, etc. If you go into an audit committee, you can take the live data and you can drag, drop, and you can show different type of variations into the data. So that is part 2. Part 1, 30, the batch size is 30. Part 2, the batch size is 25, and we already done 6 batches. Excellent feedback. We are also giving participation certificate. Technology is going to be the way forward. You'll have to adopt, and that will help in making a lot of life efficient and effective. Similarly, a lot of initiatives are happening. Any inputs, any feedback from all of you, welcome. You can write to us at wirc@ici.in. And anyone who wants to contribute by way of writing an article or being a moderator or a panelist or a speaker or even a coordinator to these type of programs, please write to us. We want more and more people to come forward and support ICI. With that, welcome again, happy learning, and thank you very much. Thank you.
Thank you, Chairman, sir. Now I request CA Sweta Jain to formally introduce our speaker, CA Arun Goenka ji. Before that, I want to request CA, our chairman, CA Murtuja Kanchwala, to give a memento. And please, Sweta, join us.
A little louder applause, please, for the speaker. Thank you.
Thank you, Pinky, for giving me this opportunity and also organizing this wonderful program. It's really a pleasure to introduce such a senior and eminent personality in our profession, CA Arun Goenka. He is a very senior chartered accountant. Since long he is into the profession and is specialized in securities law. With him, a unique blend of hands of experience of share market, law and accounts, and 3 key ingredients on which the share market survive and grow. He has donned various heads: corporate executive, corporate advisor, share broker, investment advisor, investor protection, activist, legal advisor, etc. His penetrating knowledge on the subject has been used to the advantage of small investors. He is often invited by national business news, electronic and print media for his views on SEBI-related matters. The Economic Times profiled him in its 4th August 2015 as and declared him as most influential investor you have never heard about. So also he is awarded by ICI for his noble cause as a social service person. A book titled In and Outs of the SEBI Takeover Code, Buyback and Delisting Regulation, authored by him, has just been launched in June 2022. And he has also served various committee of WRC of ICI. With this brief introduction, I welcome you, sir, at WIRC, and thank you so much for accepting the invitation.
Good evening. I welcome you all over here. And as Mr. Murtuja had said, there were more than 100 registrations, but very few turned up. I can understand if this is a program on investors awareness umbrella, most of you must be the investors. And the mayhem which has happened in the share market today might be the reason why some people are stuck. Nevertheless, let's continue with whomsoever here. Now, first of all, let me give you the brief outline of today's program, which I have in my mind. I'm not going to go into details of each and every regulation and all, because it will be a huge exercise. So I would rather try to highlight some of the provisions and will like to make it in a more interactive manner so that all your, or some, probably all your queries I'll be able to answer, or if not, I'll learn something more from you. And then we can all go home with little bit of more knowledge than which we already had. With that limited objective, let me start with some small posers, just to know the composition of the audience. Is it right to believe that all of you are having some kind of exposure in the share market? Hands up. Yeah. So we are all investors or traders in share market, and by profession, we are chartered accountants, so we understand the balance sheets and the little nitty-gritties, legal nitty-gritties of the resolutions which are coming and all. I hope when you have invested in a company and some balance sheets or any kind of notification which comes, you must be going through it. And if you go through it, you'll find somewhere in most of the cases, something which is not, quite acceptable to you. Do you raise these issues with anyone in the companies or anyone? No one. So this is where we are lacking. We will have to be proactive. In my mind, I am very proactive and I have been doing it for last 50 years or so. But the reason is I feel that this is a kind of social service which we are giving, as the doctor gives the advantage of his domain knowledge by treating people free. We as CAs can do the same thing for the cause of small investors. Wherever you find anything lacking in the balance sheet or some kind of manipulation or something wrong, you should red flag it and raise it. Earlier, raising that issues were very difficult. And I remember way back 40 years back or something, I had to take it up right up to the finance ministry stage. Now, your journey will stop at SEBI's door. SEBI is a wonderful organization. One of the best thing to happen to the investors. Now, that having said that, I not necessarily agree with whatever SEBI is doing. So many times I have taken SEBI to courts, but my conclusion is there is no need to go beyond SEBI and you cannot beat SEBI. So just accept your journey up to the SEBI, where whatever you have grievances, you raise it to SEBI and leave it at that. SEBI do take action, might be not at the speed at which you want. Now, you must have seen 2 days back, there was a press conference by SEBI amending the buyback regulation. One of the regulation which is amended is buyback from market operation mode will be stopped. This suggestion was given by me a couple of years back, but SEBI took its own time, but they did act. Similarly, if you are aware of the share market, you will find there is a counter offer. This is the first counter offer which is coming in the share market in India, and that is from DFM Food. On the delisting side, we'll come to details on that later. On the DFM Food is the first counter offer for delisting. This suggestion was given by me in 2014, but it has been acted later on. So the essence of my submission is you must raise your issue with SEBI. Don't chase them. Don't chase them. Leave it at that. And they will examine it. They will never respond to you. They never respond to me. But they do take action, as we can find out. Now, having said that, let us start today's session with introduction of SEBI. Now, what is SEBI? As you have seen, SEBI was first formed in 1988. SEBI was first formed in 1988, established as a non-statutory body, and gradually in 12th November 1992, it becomes an autonomous body. And it will be very surprising to many of you to know that SEBI Act is probably one of the very few other, I don't have any other example in my mind, where it was given with a retrospective effect. See, you see over here, it is interesting to note that SEBI Act was made applicable with a retrospective effect. It was passed on 4th April 1992, but was deemed to have come in effect on 30th January 1992. This was done, the SEBI Act came into being in the background of the Harshad Mehta episode. And that time, when in the month of January 1992, the parliament was not in session. So that is why it could not be promulgated properly. what is the role of SEBI? The preamble of SEBI says to protect the main thing is to protect the interest of small investors and regulate the share market. This is the key objective of SEBI. And how SEBI managed? SEBI is managed by its board, which has a chairman, 2 members who are officers of the central government or union ministry, then 1 representative of RBI, and remaining 5 members, which are nominated by the central government. Now, SEBI has 3 different roles: legislative, judicial, executive. As a legislative role, they formulate rules and regulations which are followed by all the listed companies and stock exchanges. As an executive role, they enforce proper follow-up, and as a judicial role, whenever you lodge a complaint with SEBI, or when they find that some wrong has been done, they take an action against them and pass an order. These orders are as good as a court order, and they can only be challenged in SAT. SAT is Securities Appellate Tribunal. And after SAT, the next recourse you have is only Supreme Court. So you can understand the value or importance of SEBI order. As I told you, SEBI is doing a very good job, and at times I find they are going overboard. Like 2 examples I've quoted over here of SEBI going overboard is in 2017, SEBI declared overnight 331 companies as shell companies and stopped their trading in the share market. Of course, aggrieved people went to the SAT, and the SAT immediately gave them relief. Similarly, in 2018, SEBI declared that 81% of the trades done in stock option platform of BSE are illegal. How can you do that? If you're doing that, you are sort of, in my mind, I would say, scoring a self-goal. If 81% of the trades were illegal, what you were doing, sir? So, and at the same time, when you are declaring like that, it creates a very poor image of the regulatory framework of the country overseas. Now, I have chosen 3 regulations to discuss over here. And these are all covered in my book, as Shweta ji has explained. Now, first regulation is SEBI Substantial Acquisition of Shares and Takeovers, Regulation 2011. This, in short, we all call a Takeover Code or Takeover Regulation. This is one of the most impactful and litigated regulation. All the, rather, majority of the disputes arising and going to the courts are on takeovers. Some of such litigation are going on for decades, like Shivama Multi-Tech, Golden Tobacco were completed after 8 to 10 years of protracted litigation. Polo Hotel is another legendary case which is pending for last 20 years. In 1999, they triggered an open offer, and till date, they have not completed it. And during this period of 2 years, 2 decades, it has gone to SEBI 9 times, NCLT 2 times, Punjab Haryana Court 2 times, Honorable SAT 3 times, and Supreme Court 4 times. Yet the offer has not seen the light of the day. These are the details of orders passed by SEBI, and these are the details of the order passed by SAT, and these are the details of the order passed by Supreme Court. I don't want to go into the details of it. It'll suffice it to say that SEBI has, as far as passing orders are concerned, done a wonderful job. They have passed, for the first time in the country, a disgorgement order on an open offer which has not been implemented. But still, they have not been able to enforce the open offer. Although the fact of the matter is, The company is very strong in the sense, if you dissect the annual report into profit and loss account and balance sheet, profit and loss account is a dustbin paper, but balance sheet, they have more than 200 crores worth of assets, which is the real estate. And yet the market cap would be something about 10, 12 crores only. Now, when is open offer triggered? Open offer is triggered when substantial shares are acquired by any outside party. Now, what is substantial? Substantial is 25% or more. If a outside person, if a third party acquires 25% shares, then it will trigger the open offer. But at the same time, if the existing promoters increase their stake by more than 5%, it will again trigger the open offer. And what is substantial for the purpose of disclosure? Acquisition of more than 5%. And subsequently, if you acquire more than 5% of the shares of any company, then you have to disclose that to SEBI and to the stock exchange. And subsequently, after having acquired 5%, if you acquire additional 2%, then again you have to inform the stock exchange and the company. There is another provision which says open offer will be triggered even when shares are not acquired, but the control of the company has been taken over. Now, how do you take a control of the company? You can take a control of the company by, without taking shares, by taking over the management, taking more seats on the board, things like that. And but over here, my biggest grievance is this provision, the regulation 4 of the SEBI takeover code, is not being implemented by SEBI properly or sincerely, I would say, because we find every day so many cases where companies are sold lock, stock and barrel, but no open offer is triggered. Like I would like to say one of the earlier such cases where Abbott Laboratories, billions of dollars, Orchid Chemical, it was, I've given a detail. In Orchid Chemical, the acquisition price was more than the market capitalization. So the essence of my submission is, if the market cap is 1,000 crores of a company, and if someone buys 250 crores, that is 25% of the shares, then open offer is triggered. But if the entire company, entire facility, entire workmen's and management team and everything is acquired at even 1,000 crore or 1,500 crores, then open offer is not triggered. This is quite funny, and SEBI needs to look into it seriously. Now, I have tried to take a holistic view of why open offer is not triggered in such a situation. SEBI's point of view is, in case of sale of assets, say Orchid Chemical, I'm specifically remembering, the amount paid was 1,500 crores. No, market cap was 1,500 crores and it was taken over for 400 million. At that point of time, that is 2009, the exchange rate basis, it was approximately 1,860 crores. So 50, if let us say 400 crores ka shares, if the company acquires would have taken, then it would have triggered open offer. But 1,860 crores ka, that is 4 times more of that, they have bought the company and yet no open offer is triggered. In case of Gwalior Chemical, it was clearly said that everything, all the employees, all the working plant and machinery, all the facilities and everything is sold to the person, the acquirer. Yet open offer is not triggered. So this brings down to the point, what is a company? When the regulation says, when a target company, control of a target company is taken over. So what is the company? The way it is being enacted, it would mean that I should not say enacted, acted upon. Enacted तो properly किया है, acting नहीं करते हैं उस पे. The way it is acted upon, it means that shareholder a company is just a boardroom जहाँ पे registry statutory registers रखे हुए हैं. And if your name is changed in that statutory register, then the company is taken over, the control of the company is taken over. Otherwise, the heart and soul and body of the entire company, which is the manufacturing facilities, plant and machinery, sales team, and accounts team and all, they don't matter. Again, I have tried to elaborate on Orchid Chemical. Orchid Chemical was done under the 1997 regulation where the trigger point was 15%. Today it is 25%. I have tried to build up some argument why SEBI is not enforcing open offer when the assets are slump sale basis pay company is taken over. Now, SEBI might say, in case where the promoter is ceding control to an acquirer, the promoter is exiting at the negotiated price. When there is a share sale, the promoter is exiting at a negotiated price, and the advantage of such higher negotiated price. See, whenever the control passes on, the price is at a premium because the control element is there. When the promoter is negotiating with the higher control premium, the same benefit should accrue to the ordinary shareholders also. That is the essence why open offer is being triggered. Now, when the small shareholder, retail shareholders are not part of this decision-taking process. Whereas in case the shares are whereas in case the company is acquired to slump sale basis, there is a special resolution which is passed, wherein all the small shareholders are also participating. So you are a part of the process of decision taking. That is why we are not allowing you the privilege of open offer. I have covered all these points here. Now, the next item which I want to touch upon is frequently traded shares. Frequently traded shares is one such item which generates a lot of disputes and court cases. The formula for determining a price at which the open offer should be done is given in the regulation, 4-5 bases, like say, roughly I'm telling you, 2 weeks average, 15 days average, high and low, and all such things. When the shares are frequently traded. But if the shares are not frequently traded, then it will have to be valued. Over here, the dispute arises. When valuation, as has been said in so many cases, even Sultania and all, which is one of the earliest cases, even Supreme Court said, valuation is very subjective. There cannot be a mathematical formula for valuation. So if you appoint 3 valuers, all of them will value the same product, same company differently. This leads to litigation. Recently, we have seen a high-profile case of Federal Mughal, where the valuation went up. It was done by reputed chartered accountancy firms, and subsequently, some shareholders challenged the valuation. The SEBI appointed another valuer, which was challenged in SAT, and SAT said, no, there's no harm in getting the valuation done by another valuer. And the SEBI appointed valuer valued the company at much higher price, and accordingly, the price had to be revised. So 10% revision in the price may mean a cost of more than 100 crores to the acquirer, because these are all huge companies. So you can understand they keep on fighting, and they keep the biggest names like Janak Dwakadas or someone, biggest names they bring in, So it's very difficult for we shareholders to fight against them. It is just best to put our fund through SEBI. That's what I said. The best recourse for us is to go through the SEBI route. Now, frequently traded shares, as per the new regulation, within the 12 month, if there is less than 10% turnover, then the shares are not frequently traded. And how do we calculate the turnover? Is only on one exchange. Like we all know that BSE and NSE are the two exchanges, but we cannot combine the trading turnover of both the exchanges. If 9% of this capital is traded in BSE and 7% on NSE, or might be vice versa, 9% on NSE or 7% on BSE, the total turnover is 16%. Yet it will be taken as infrequently traded because in none of the exchange it has cost more than 10% of 10% of the capital. Over here, we have to also understand in share market, if there are 1,000 shares sold, it doesn't mean that people have invested in 1,000 shares. Most of them, or many of them, would get squared up intraday. So it's not the delivery turnover which is material, it is the trading turnover which is material. Now, there is another interesting point which I would like to highlight over here is interpretation of definition. There is a standard clause written unless the context otherwise requires. This has been used in case of exchanging to give a different meaning to a well-defined definition. In case of frequently traded shares, the definition says the reference date is the date earlier before the regulation has been changed, but before the change of the regulation, the operative part was frequency will be tested with reference to the date of the PA. The date on which the PA is announced. PA is public announcement. Now this has been changed into saying that the reference date would be the date on which PA should have been announced. And although when exchanging case came up, it was still under the unchanged law, but taking recourse to frequently unless the context otherwise requires, SEBI interpreted that the shares, because the dispute was in case of exchanging, the date on which the public announcement was announced, the shares were infrequently traded and would have required to be valued properly. Whereas on the day it was required to be made, it was frequently traded. So they wanted to avoid this. And SEBI took recourse under the phrase, unless the context otherwise requires, and said date means the date on which the PA should have been announced. Now, another question, interesting definition is acquirer. Acquirer, as you would feel, is someone who has acquired. That's not necessary. As per law, the acquirer is a person who has agreed to acquire and also acquires whatever. If you don't acquire, but you have agreed to acquire, you are still invoking the provisions of takeover regulation. There are cases like Dish TV, wherein the promoter asks the share broker to buy X number of shares, which would take their acquisition beyond 5%, and that triggered an open offer. That may trigger an open offer. But the fact is, the shares were never acquired because the price given for acquisition was not available. Yet SEBI said that you have agreed to acquire, so that is why you have to come out with an open offer, and they had to comply with the open offer. This provision, although is made for the benefit of shareholders, was used or misused by L&T in the case of Mindtree. Now, we all know when L&T took over Mindtree, L&T was not having any shares in Mindtree. And there is no provision as such, which allows you to make a voluntary open offer. But in this case, what they did is, they said they have placed an order with Axis Bank share broking to buy the shares, say 26% of the equity. And that is why they have triggered the open offer and enforced and came out with the open offer. And we all know subsequently they took over the company. Another interesting definition which we'd like to discuss is immediate relative. Immediate relative means any spouse of a person and includes parents, brother, sister, or child of such person or of the spouse. This is very interesting and needs to be deliberated in detail. I would like to read it out from my text. Immediate relative. A spouse means a husband or a wife of a man. A person can be referred to as a spouse only till such time as the marriage is valid. If there has been a divorce, then the lady or the man are no longer your spouse. The term any before spouse includes situation wherein a person has more than one spouse. Otherwise, there is no reason why the word any should be there. Now, coming to child. Child of such person or the spouse may be difficult to establish. For example, we are taking live example, which is quite interesting and amusing. Peter Mukherjee and Indrani Mukherjee, both of who married multiple times, and the paternity of the child, Sina Bora, was hidden from the husband. Similarly is the case of N.D. Tiwari, who never acknowledged that Rohit Shekhar Salma, bracket mein Tiwari, was his son outside the wedlock. It seems that even an illegitimate child will be considered immediate relative, since nonetheless, she is the child of a person or of the spouse. However, the status of a child born to a spouse from a previous marriage remains unclear. I'm not able to establish if, in case of Sheena Bora, she was born from the previous marriage of Indrani Mukherjee, whether Peter Mukherjee will still be obliged to consider Sheena as her daughter. Offer period. Often, offer period is also important and crucial definition because it comes into play since there's many restrictions which are prevalent during the offer period. One case law I am trying to discuss here. In the matter of Punusar Holding, SEBI versus SEBI, before the SAT, it was contended that the appellant, I'll have to wear my glasses, sorry, that the appellant, the word between in the definition. Now, the definition is offer period is an important milestone. Between in the definition signifies that it does not start from the date of execution of the share purchase agreement, but from the day immediately following the day. Else the word should have been from the date and not between the date. The SAT held that according to the calendar that we follow, the date would commence from the midnight, and therefore the bar will commence from the midnight of the day when the memorandum of understanding is signed, and the same would continue. So I'd like to explain it a bit more. In Punsar Holding, the acquirer said the word given is between. So that is, if on the 4th, let us say 4th of December, if the agreement is done, so from 5th onward, the days will be counted. But the court said the calendar we follow from the 4th midnight, it will be 5th. So you have to follow that. I have rushed through takeovers. If you have any questions, you can ask. Otherwise, we'll move because we have to cover delisting and buyback as well. And it's already 6:15. So you have any questions, any queries? Okay. So I would feel that rather than moving to delisting, we should first move to buyback. We should first discuss buyback. See, in common parlance, we find people referring to even takeover or delisting everything as buyback. अबे उस कंपनी का buyback चालू है ना? अबे this is not buyback, this is delisting. DFM का buyback चालू ना? This is delisting. Or some other company, they will say, इसका buyback चालू है ना? No, it's not buyback, it is takeover. Now, what is the difference between buyback and takeover? I've made out a table over here. Let's see, let us go to the table. Now, what is the difference between buyback and takeover? Takeover is a mandatory thing. If you have acquired certain number of shares, certain percentage of shares of the company, then you are mandatorily required to come out with an open offer. Whereas buyback is voluntary. आपको लगा कि आपके पास बहुत पैसा पड़ा हुआ है, खाली है, you don't have any use for it, and the market price of the shares are very low. Your shares deserve to be valued higher. So you made out an buyback offer. The company and many a times unwilling. So when there is a mandatory thing, the person is not willing to shell extra money, because while buying a company, he has already given a huge premium, or he has exhausted his means or whatever. He doesn't want to come out with an open offer. So people hide the fact that they have taken over a company, so that there is no statutory obligation for them to come out with an open offer. And when this thing come into forefront, then they are statutorily obliged to come out with an open offer, which they resist. That is why litigation goes on. Like interesting episode I would like to share with you is in case of Polo Hotels. Polo Hotels, what happened is Polo Hotel acquired the shares from the promoter. There was a Garg family who had promoted this hotel, and they acquired the shares at 8 rupees 50 paisa. Subsequently, this Garg family had borrowed money from Haryana State Industrial Development Corporation, HSIDC. And HSDC was holding something about 15% equity of the company. So the promoter, the acquirer, had to buy the shares from HSIDC. And we know, like all these government bodies and all, they will not sell at less than our cost plus interest. So HSIDC put their foot down. They said, no, nothing doing. We will not give you the shares at less than our cost and interest. So the cost and interest taken together came to 23 rupees 75 paisa. So the promoter paid 23 rupees 75 paisa and kept silent about it. Came out with he was fully aware that he has to come out with an open offer. So he said, my acquisition is 8 rupees 50 paisa and I'll announce the open offer at 8 rupees 50 paisa. Subsequently, one shareholder, just like you and me, complained to SEBI that he is hiding the fact that he has acquired the shares from HSIDC at 23 rupees 75 paisa. When SEBI inquired into it, no one was cooperating. we all know how to manage these people. He managed the HSIDC also, and HSIDC will not respond to SEBI. Have you sold the shares at 23 rupees 75 paisa? No one was answering to that. Ultimately, after a long time, SEBI had to force them to give an official reply, and they said, yes, a check of rupees so-and-so was received, calculated at 23 rupees 75 paisa. And so SEBI ordered the acquirer, there is a Dahiya family based in Chandigarh, to come out with an open offer at 23 rupees 75 paisa. Now, the excuse or plea which this acquirer took is all very interesting. He says, first of all, he said, I have not bought the shares. I have just liquidated the loan account. So there is no purchase. Purchase is shares I got is a consequential part of me paying off the loan. SEBI said nothing doing. You have paid this money and the price was calculated as per share, and the shares you have bought at 23 rupees 75 paisa. So the offer will have to be come at 23 rupees 75 paisa. Now the promoter, anyway, I don't want to cast anything personal on anyone. Now the promoter came out with a brilliant idea. अरे मैंने चेक दिया था तो क्या हुआ? चेक तो सिकला ही नहीं. The check was not honored. So I've not bought the shares. So I don't incur the liability of open offer. Then again, SEBI said, or it went up to the SAT. SAT said, your check was honored or not. It is separate matter. The fact of the matter is you have bought the shares and you have paid. So you have to come out with it open offer. Iske baad, another brainwave comes in his mind, and he comes up and says, although I have bought shares from HSIDC, but there are a list of institutions from whom if you buy, it will not trigger an open offer. So he says, since HSIDC being a state industrial development corporation, when we buy shares from it, it will not trigger an open offer. So no open offer is triggered. क्या हो गया? Time out हो गया होगा लगता है. It will not trigger an open offer. Now, to answer to this was, although it will not trigger an open offer, but it will be considered as the basis on which the price of any existing open offer will be determined. So the open offer was not triggered by his purchases from HSIDC. Open offer was triggered because of his purchases from Mr. Garg, but the price was highest of the price paid. So highest of the price paid was to HSIDC. That is why the price will be 23 rupees 75 paisa. Now, what is the motive behind open takeover, and what is the motive behind buyback? The motive behind buyback is to reward the shareholders, whereas and enhance the value of the shares of the company, whereas the motive of open offer is to acquire the company. Who are the key players? In case of takeover, the key players are acquirer, the promoters and the selling shareholders and public shareholders, and the target company. But in case of buyback, the shares are acquired by the company, not by the promoters. And the shareholder of the other side who participates in the open offer on the buyback. Emphasis of the regulation on treatment of shareholders. In both the cases, a fair and equal treatment to both the to small shareholders will have to be there. In case of open offer, equal and fair treatment to small shareholders, same price to public shareholders, minimum offer of 26%. That is the norm. Whereas in the buyback, The buyback is a maximum 25% of the capital or capital and fee reserve is what the company can use for making a buyback offer. And yet it should be from your own earned money. It should not be from loan money. We all know, again, I'm referring to the case of Larsen and Toubro. In my memory, only one buyback was cancelled by SEBI or disallowed by SEBI. It was Larsen and Toubro because the debt equity ratio was not proper. And it appeared to SEBI on its examination that they were using borrowed money to buy back shares. And in case of buyback, 15%, in case of buyback, as of now, there are two methods. One is open market purchase and the other is tender method. In case of open market purchase, the promoters cannot participate. It's only the public shareholder who can participate. And the company has a 6-month time window within which they can buy the shares. And every single day, they will have to make a disclosure to the stock exchange of number of shares bought or not bought. You will find in my, I don't know if you have seen my book. In my book, I have given a reference of Sun Pharma, who came out with an open offer buyback, but the price went ahead of the buyback price, and they didn't buy a single share, yet for every single day, they had to give a disclosure to the stock exchange that they have not bought any shares. So this is a very strict rule to be followed. Now, in the tender method, you have to reserve 15% of the offer size for small shareholders. This is where we can all make money. And let me admit that I am one of them who constantly participate in buybacks and open offers. Now, 15% of the size of the offer is reserved for small shareholders. Who are the small shareholders? Small shareholders are the holders whose market value of the shareholding as on the record date is less than 2 lakhs of rupees. In case of takeover, it involves change of management. But in case of buyback, there is no change of management. In case of open offer, the shares change their name from the previous owner to the acquirer. But in case of buyback, the shares are simply extinguished. So the share capital of the company gets reduced. Litigation we have already spoken about. I'll just have some. Over here, I've tried to highlight an anomaly in the disclosure. Now, as per the existent norms, the company has to disclose their shareholding, and one column is shares up to 2 lakhs. This 2 lakhs is not defined. What is this 2 lakhs? 2 lakhs, but in essence, what is being done is 2 lakhs of nominal capital, they are saying. Like in case of 2 lakhs of nominal capital, that means like say in case of TCS, which has a face value of 1, 2 lakhs means 2 lakhs shares. Ab 2 lakh shares ka value aap nikaloge for 3,500 or something. It's absolutely way above 2 lakhs rupees, which is the intention of the law. But they are not taking care of this. And there's no way we can assess how many people are eligible to participate as a small shareholder. This is the definition of working day. As I said, the working day is also very important to calculate the so many legal obligations. And what I found during my course of study is working day means that the working day of the board. A list of holidays as per RBI for the month of August 2020 has been summarized below. You will find that Bakrid is a holiday in 28 states. And Independence Day is a holiday on 31 states. But all other holidays, which are Hindu festivals like Raksha Bandhan, Janmashtami, then the Ganesh Chaturthi, which are very popular. Even in Ganesh Chaturthi, there are only seven states where there is a holiday. Now we come to DVR. This is again an interesting provision. As we know, for past some years, companies have been able to issue DVRs. DVRs are differential voting rights, like Tata Motor DVR. DVRs are in share market valued much lower than the shares. In my mind, this kind of discount is not fair. It should not be there. But anyway, that's another matter. Over here, what I'm trying to say is DVR is a differential voting right. Differential voting right means it could be more, it could be less. In case of Tata Motors, 10 shares will give you one voting right. 10 DVRs will give you one vote. Whereas one share gives you one vote, we all know. Whereas in case of Jagjit Industry, like say, this is inferior voting right. And there could be similarly superior voting right. In case of Jagjit Industries, it was each share giving you 10 voting rights. Now, the way the wording is there in the buyback regulation, there can be a buyback for Tata Motors DVR, but there cannot be a buyback for Jagjit Industries DVR, which has a superior voting rights. Maximum amount of buyback I've already told, 25% or 15% in case of open market purchase. Post-market buyback, we have already discussed. Minimum gap of 1 year. Yeah. Now, a company can announce buyback only after 1 year, follow-up buyback only after 1 year. This, the SEBI is considering to reduce it to 6 months. After 6 months, the company can again announce a buyback. Buyback, apart from buyback, no company can buy its own shares, not even through its subsidiary. We have discussed about Larsen and Toubro. Now, open market buyback, why open market buyback is dangerous, and this is how what I had also written to SEBI, as I told you, and that is why the regulation is being withdrawn. In future, gradually after 3 years, they are gradually withdrawing it. Open market purchase will not be given. One of the example is e-clerk. Contrary to the regulation 4, sub-regulation 4, it appears that the company had entered into a negotiated deal. The buyback started on 15th July 2020, and on 16th July 2020, the very second day of the offer, more than 50% of the offer size was purchased from one single entity. the troubled Franklin Templeton Mutual Fund. This clearly leads to a belief that this was a negotiated settlement, which is expressly barred by the law. The buyback regulation says you cannot have a side agreement that, okay, I'll make a buyback offer and you say, put the shares and I'll buy it back. The Small Investors Welfare Association has taken up the matter with SEBI. Now I've given the table. E-Clerk completed recently announced buyback by within 9 working days, as against 6 months time, they completed the buyback. On 15th July, they bought 66 lakh shares. On 16th July, they bought 14 crore shares. On 17th July, they bought 1 crore shares. And 20th July, they bought 40,000 shares. On 21st July, they bought 3 crore shares. And 22nd July, they bought 1 crore 73 lakh shares. So the total of 21 crore shares were bought within 9 days. So when there is a tender offer, when there is a tender offer, you get ample opportunity to participate. And over here, you will feel कि 6 महीने का time है, gradually करेंगे आगे पीछे, but they will rush through and finish it off. So my suggestion to SEBI was, on second day of the buybacks, 14 lakhs, 14 crores, whether the buyback was announced to bail out. SEBI has to find whether the buyback was announced to bail out the troubled Franklin Fund in tender method 15%. So the point was, I'm always fighting for small shareholders. So my point was, in the tender method, quota of 15% is fixed for small shareholders. But in the open market purchases like this, more than 50% of the quota was usurped by one single entity. Who put the order first? Whether buy order was given first or the sell order was given first. This may bring out the insider trading violation committed by both the parties. This fact about purchase from a single entity should have been disclosed in daily reporting of the shares. As I told you, they have to disclose daily how many shares they have bought. So they should disclose that from one single entity, they have made such a huge purchases. Preference given to minority shareholder in tender method, why not in open market? SEBI regulation needs to be tightened. Since it is already going, so we are not elaborating on that. The impact of announcement by SEBI. Over here, I've discussed the market purchase from this Bajaj Auto. But since this provision is likely to go off, I'm not elaborating on that. Now, buyback through tender method. There is an interesting case of HEG. HEG, the offer was on 22nd March 2019. Small shareholders 17, it was at a very high price, 5,500 or something. Small shareholders 17 out of 222 equity shares held on the record date, approximately 7%, whereas in the general category, 19 out of 447, that is 4.27% were accepted. Going by this ratio, if someone is holding, say, 220 shares, then he may decide to tender only 27 shares. See, if you are holding, say, 100 shares, and if you, before tendering the shares, you receive a letter of offer, which will give you the actual number of shares which you are entitled to. So how it happens is, if all the shareholders tender their shares, then you will be able to tender only, or rather your offer will be accepted only to the extent of your entitlement. But if the buyback offer is undersubscribed, then if for the other people who have not participated, that will fall back on you, and you will your more number of shares can be accepted. So the point over here is, when the buyback is at a much higher price, you can assume that 99% of the people will subscribe. So you need not tender your entire shareholding. You can only tender up to your actual number of shares entitlement. Because in this case of HEG, only 27 shares out of 227 were accepted, and when the balance shares came, the prices were very, very low. You see, The offer price was 5,500, market price was 2,100 approx. The acceptance was about 17%. However, after the offer closed, the price fell to 820. So with this kind of insight, you can avoid your losses in any buyback offer. Obligation of the company for all buyback procedure, consideration to be paid only by cash. Yeah. So these are some basic rules of buyback. Like the consideration will have to be cash only. A company cannot say, okay, I'll buy your shares and issue debenture instead of that. Or might say, I'll give you a chocolate. Aisa nahi hoga. Cannot withdraw the offer after the draft letter offer is filed or public announcement. Although this is the rule, but strangely, I remember Thomas Cook is one case where buyback offer was announced, but never implemented. So in a way, it was withdrawn. But you have to also consider that in between, there was COVID and economic situation was very bad. And Thomas Cook is a company related to travel and leisure. So they were into bad shape. So they were probably allowed, or SEBI didn't force them to complete the buyback offer. Although the rule says once the buyback offer is made, cannot be withdrawn. When there is any corporate action like amalgamation pending, no buyback can take place. And at the same time, the shares which are locked in cannot be tendered in the buyback offer. This is one interesting aspect you'd like to understand. When shares are locked in, you cannot tender them in buyback, but the locked in shares can be tendered in open offer. The reason is very, plain, I would say. Because in buyback, the shares are extinguished. So within the lock-in period, you cannot extinguish the share. Whereas in the open offer, the shares are transferred and the lock-in, like the shares which you are having 3 years lock-in, will continue to have 3 years lock-in when he is becoming the shareholder. So the lock-in is also transferred. When the shares are partly paid, there cannot be any change in the capital of the company. Special resolution is not required. This is another interesting point. When there is an offer for buyback by a company and the size of the offer is less than 10% of the net worth, then you don't have to obtain, means the company don't have to obtain shareholders' permission. But if the company is going to use more than 10% of its capital to acquire the shares, then it has to be passed through a special resolution of the shareholders. Buyback can only be done for fully paid up shares, not partly paid up shares. Now, taxation. From the investor's point of view, buyback is quite beneficial. Dividend is taxable and even TDS is deducted. Long-term capital gain tax is taxable beyond 1 lakh. Short-term capital gain is taxable at a special rate of 15%. But buyback is tax-free. No TDS or no income tax. Because under DDT, the company pays the income tax. So in a way, if you bought a share at 10 rupees and the market price is 100 rupees, and offer is also at 100 rupees, you should rather sell it in the buyback offer so that you get advantage of the tax that has been paid by that is being paid by the company for you. Income on buyback of equity shares is exempt from tax under 1034A of the ITA. The company buying back shares now has paid 115 QA distributed income is the difference between the amount paid. In case of open market purchase, I am skipping. So we have covered takeover, we have covered buyback. Now we'll cover delisting, another important. So far, any questions by anyone? More transparent. You feel as of now it is not so very transparent? No, that was buyback, not open offer. हाँ. No, वो तो हो ही गया ना. SEBI has acted on this. That is what I said. Abhi, 2 days back, there was a meeting and the SEBI announced that they will phase out open market purchase, buyback through open market purchase. So what point is taken care of. And otherwise, so I feel the process is quite transparent, to be fair, quite transparent. Transparency का issue नहीं है. See, buyback is voluntarily. तो voluntary जो कोई आदमी कर रहा है तो वो he is aware of the consequences. तो उसको क्या problem है comply करने में? If he feels the compliance cost is much high and not desirable, he will not make the offer. It is only in the case of delisting, or delisting meaning in the case of takeover, which is imposed upon a person, that he tries to wriggle out of it. कहाँ पतली गली से निकल जाऊं मैं? हमेशा रहती है. Certainly, certainly. I told you, I do it. I do it. This is my main focus, and it has been my main focus of investment for might be since the days of Castrol. That means more than 2 decades. I have been doing it as a passion, as an investor, and as an investor protection activist, I would say. So, and this is what led me to write the book. If you read my book, you will find a lot of practical cases, which is rare to find in, and I don't know, is there other books, legal book written by chartered accountant of someone who is not a lawyer. This is essentially a book on law and written by a chartered accountant. I'm not a lawyer. So I don't know if there is other such examples or not, but I feel it is something unique. Now coming to delisting. Delisting, why the company will come out with delisting? No, sorry, I made a mistake. It's not the company which comes out with delisting. So we have to understand there are 3 aspects. One is takeover, the other is buyback, and yet another is delisting. The company acts only in the case of buyback. Buyback it is initiated by the company. All other things, the company is a passive player. Passive player. उसको खास कुछ करने का है नहीं, apart from giving disclosures, apart from making its books available and things like that. Now, the motive of takeover is to acquire control of a company. you find Hindustan Lever is a very profitable company, I would like to acquire the company. You can make an open offer. Like Larsen Toubro did for Mindtree. But in case of buyback, the motive is to reward the shareholders. The company feels ki, like said TCS feels there are thousands of crores lying in my balance sheet. I don't have any use for them. I'm not going to acquire any new companies. So मैं क्या करूँगा इस पैसे का? तो चलो shareholder को दे देते हैं. And they give it to shareholders, which increases the profitability. If you calculate the ratios, it will improve the ratios because let us say 5% of the equity ka buyback ho gaya. So the denominator gets reduced from 100 to 95. So EPS, PE, all these ratios, we are all chartered account, we know how the value is determined. So all these values goes up. And at the same time, it sucks the liquidity from the market. So वैसे भी floating stock कम हो जाता है. Then also the price goes up. Yet another angle is the shareholders feel, क्या ये company अच्छा है? इसमें से तो पैसा आते रहता है. So let us be invested in such companies. So that is the objective of buyback. Now delisting, why delisting takes place? Delisting takes place because the promoter feels there is a lot of hidden wealth in the company, which the market is not able to appreciate. Like say for example, Vedanta. Vedanta came out with an open offer. I don't remember the numbers correctly, but somewhere around 120. Thinking that हमारा price तो 80 rupees, 90 rupees है, 120 is good enough. Promoters should pay. All the shareholders should tender their shares. And they came out with an delisting offer. We all know what happened. The offer failed and the price of the shares went up to 300. So when there is a lot of hidden value in the company, and when the promoter feels कि हमारी company तो कोड़ियों के भाव में पड़ी है, let us take it up, they will come for an open offer. At the same time, some companies get acquired internationally, and internationally when they get acquired, then the philosophy of the investors, some of the investors, they never invest in a listed company. So the philosophy of the investor is, हमको listed company नहीं चाहिए. So they will get this company delisted. The current example of DFM Food, I found it very strange. DFM Food, the floor price was 220 to 225. I don't know, anyone of you have followed DFM Food? किसी ने नहीं follow किया. Can you guess what is the discovered price as against the 225 rupees floor price? Absolutely. So 225 का जो floor price था, उसके against में people are expecting 525 rupees. Now come back. What is the book value of that shares? Any guesses? Just 25 rupees. 25 rupees ka shares, the company was willing to buy at 225 rupees, but you and me shareholders said, nahin, tumko chahiye to humko 525 dena padega. And to my surprise, the promoter is still willing to pay 467 rupees. So what is the hidden worth or agenda in that, I don't know. But for a company which having a book value of 25 rupees, why 467 rupees the promoters are willing to pay? I don't understand. There must be something behind the curtain which we are not able to find. Nevertheless, as far as arbitrage opportunity is concerned, you can still buy, rather I bought yesterday at 445 rupees, and you will be able to give it at 467 rupees. But you must remember the reason that there is a slight risk. The risk is if there's not enough number of people who are offering at 467 rupees, then the offer again fails. But in the background, of the book price being 25 rupees and the floor price being 225 rupees, I don't think there should be any reason why people will not offer it at 467 rupees. Okay. Now, delisting is of two types. One is voluntary delisting. As I said, the point we discussed is voluntary delisting. Okay. Voluntary delisting, let us see what does the note say. Voluntary delisting is mainly resorted to by multinational companies, although there are some Indian promoters who got their shares delisted, like Manjushri Technopack, SR Oil. Now, these companies also got delisted because they had someone behind their back to purchase the shares. In SR Oil, they sold this to the Russian Rosenfeld. I'm not able to pronounce the name properly. Rosenfeld or something ऐसा नाम है उनका, Russian company को. And when it came to the knowledge of SEBI, SEBI asked them to enhance the offer price. So SR Shipping, SR Oil had to enhance or pay roughly about 1,000 crores more for the delisting to obtain full ownership of the equity shares. Now, what are the reasons when you are making a delisting offer, you have to give the reasons why you are opting for delisting. So these are some of the reasons given in the offer document. To obtain full ownership of equity shares of the company, to get operational flexibility to support the company's business, to take care of future financing needs of the company, to reduce the expenses of maintenance of listing and investor relations. So this is one big issue reported by almost all the offers, that they want to reduce the cost of listing and investor relationship. To serve the management to save the management bandwidth, which can be redirected to company's business. Now, what is compulsory delisting? Compulsory delisting is when the company is not managed properly and and they are not complying with the rules and regulations of the stock exchange and SEBI. The stock exchange compulsorily delists them. Regularly, you will find there is announcement by BSE and NSE that so many companies have been delisted. On the day I studied it, I've written that 222 companies were compulsorily delisted by SEBI. The promoters of this, now what are the consequences of delisting? The consequences of compulsory delisting is the companies will have to, the promoters will have to buy each one of your shares at a price to be determined as per the formula given in the takeover regulation. The promoters of these delisted companies will be required to purchase the shares from the public shareholders as per the fair value determined by the independent valuer. The delisted company, it's whole-time directors now, I've already covered this. Comparative charts showing unique features of takeover, buyback, and delisting. We have already covered takeover and buyback. Delisting is added. I've covered this. Recommendation for Vietnam. Size of the offer. Now, size of the offer, as I told you, in case of open offer, minimum size prescribed is 26. You can offer to acquire higher number of shares. Whereas, in case of buyback, the size is not in terms of percentage of share capital, but in terms of capital and free reserve. You cannot use more than 25% of the capital and free reserve. Accordingly, whatever number of shares it will come, usually you will find the offer for buyback is for 2 to 5% of the number of shares issued. Most of the offers, if you tabulate, you will find 2 to 5% kuch aata hai. Whereas, in case of delisting, you have to make such offer for such number of shares which are outstanding. No, I have to rephrase this. You have to make an offer for entire share capital which is not with you. The entire share capital raised, number of shares lying with the public, you have to acquire them. So that is the size of the offer in case of delisting. Now, let us say the share capital is 100 number of shares and you have 60 shares with you, then you have to make an offer for 40 shares. I'm just trying to make very simple and by taking a small example. But the entire 40 shares need not be tendered in the open offer. However, you have to receive at least 30 shares. Like your shareholding should increase beyond 90%. 90% is the threshold. अगर आप 90% को cross नहीं कर पाते हैं, then your open offer, your delisting offer fails. This is what had happened in case of Vedanta. The offer failed because Anil Agarwal was not able to cross the threshold of 90% of the equity, even after taking the shares already there with him. The another reason how the delisting offer can fail is shares to aa gaya, but the price at which it has come, I am not happy. Like DFM food, the price had come at 525 rupees. I'm not happy with that. I cannot pay so much. So this SEBI has given a second chance to both the investors and the promoters. Ki chalo, you give a midway offer, and if it is acceptable to the shareholders, they will accept it. So that is why the counter offer has come, and this is the first counter offer in the country. Over here, we tabulated it. Delisting floor price was 263 rupees 80 paisa. Discovered price was 525. Counter offer is 467. Book value was 25 rupees 90 paisa. And it is certified by one of our fellow chartered accountant, NBT and company. Now, what happens if you have already tendered your shares in the delisting offer? You can, and if you don't find the price of 467 acceptable to you, you can withdraw it. If you find that 467 milega to chalega, then you can leave it over there. And automatically you will get 467 rupees. At the same time, if you are a person who had not tendered your shares earlier, you can tender it now. That brings the end of the session from me. If you have any queries and questions, you are welcome to ask. Thank you.
Thank you. Thank you, Arunji, for such a nice presentation on a difficult topic, you can say. ये थोड़ा टेक्निकल टॉपिक है, सेबी और टेक ओवर डिलिस्टिंग. जो इसमें वर्क कर रहा है वही थोड़ा अच्छे से समझ सकते हैं, बट यू हैव डिलीवर्ड वेरी वेल. सो आई रिक्वेस्ट सीए देवांग संपत जी to give a formal vote of thanks. So please.
It is my privilege to propose vote of thanks to such a learned senior. Accidentally, I was coming for some another program which got changed, and I had a very great opportunity to hear this program. Although I congratulated Arunji for his book, but I'd never read his book. But today, first thing I'm going to do is go home and read his book. It is very rare to have a chartered accountant writing such books on legal aspects, and we as chartered accountants will feel proud of him to get into a field where laws have their prominence. Maybe his book will also cover the commercial aspects as we have seen in this presentation, along with legal aspects as we all like. Here's a 360-degree view of maybe the businesses, the functioning of law, maybe commercial, legal aspects, everything, maybe exactly what the environment requires, the business requires. And that is something also which we could learn from him. So I really thank him for the great presentation and his maybe my privilege to propose a vote of thanks to such a senior person. Thank you, sir.
थैंक यू. देयर इज मोर फिजिकल प्रोग्राम. 31st तक बहुत सारे फिजिकल प्रोग्राम हैं एंड स्ट्रक्चर सीपी के लिए फिजिकल प्रोग्राम ही करने पड़ेंगे आप लोगों को. अनस्ट्रक्चर सीपी वर्चुअल में अनस्ट्रक्चर मिलता है. वर्चुअल में भी 8 आवर्स तक आपको स्ट्रक्चर मिलेगा. 8 आवर्स के बाद में आपका अनस्ट्रक्चर में कन्वर्ट हो जाएगा. ठीक है. तो अभी आगे भी हमारा 27 को भी है फिजिकल प्रोग्राम, 28 को भी है यहाँ पर फिजिकल प्रोग्राम. सो यू कैन वॉच ऑन द WRC के